Hey traders, welcome to Charts and Coffee. Happy Thursday, everybody. We've got some major events coming up today, mostly of the earnings variety. But one of the things that I like to keep in mind with the day after the FOMC is that a lot of times we can see some sort of lingering volatility as we have one full session to sort of digest what the FOMC statement really is, what the press conference revealed, and then of course we'll use our magic decoder ring of the federal funds futures. So if I take a look at that, this is a futures contract that tracks what expectations for the meetings are. Now, one of the things that's going to be very important to remember is that it's not really September. That's the conversation at the moment. So, okay, Rog, why do I look at this? Why does it matter? Because expectations are for lower rates. Now it's not a matter of when are the rate cuts going to begin. It is fully discounted that it starts in September, but we know that already. So what's next? Remember, the market's always asking what's new, what's next. And now that means we need to see a steady track of September rate cut, quarter point, November rate cut, quarter point. And it's going to take us all the way into June, potentially of next year, where the expectations are that the current rate of 5.25% to 5.5% is going to drop to 3.75% to 4%. So we're talking minimum at least 125 basis points or 1.25% up to maybe 1.5%. And as long as we're on that track, and this is the same thing that we'll be saying for a while, we can't really be longer term bearish. I mean, sure, we're going to have months like we did in April, where there was a lot of volatility, and we're seeing a very April-ish month in the S&P and the NASDAQ, where we had a lot of volatility, a lot of bearish chop. And then as we're starting August, we're going to see, all right, clean slate, new month. What's the mood as we get out of that August action, as we get out of the July action into August? So continuation is the highest probability. Look at April back here, this cluster of red. And then what happened? After all that confusion, folks finally got out of the malaise of April and said, oh, but yeah, we have rate cuts still coming. And also, probably the most important thing to note is that not all four indices, S&P, NASDAQ, Russell, Dow, have to move together. Right? This idea that risk appetite is going to benefit all the sectors, all the stocks equally is very much a misnomer. The Dow and the Russell had a really, relative to the NASDAQ and the S&P, the Dow and the Russell had a pretty darn good July. In fact, that's where going into the Q3 action, that's where the interest went. So as we go into the end of Q3, and I know it's still 2 months away, we'll talk about this particular phenomena again. But the longer we can see the Dow and Russell stay steady while the S&P and the NASDAQ are going to join the party, that's what broad participation would look like, right? I'm not interested in all 500 stocks of the S&P or all 100 stocks of the NASDAQ. We are both interested in what? You and I got to be interested in what are the Magnificent Seven doing. So that brings us to Apple. That brings us to Amazon. That brings us to Meta and Microsoft this week. Right there, you've got, 4 of the 7 not so magnificent lately. It's going to be very important as we come out of this week that we have a non-farm payrolls number that doesn't upset the expectation of the rate cuts. It's going to be very important as we come out of this week that Powell reiterated their plan, which I would say largely he did, which is to cut rates. And then now we have to see that certain stocks that have been lagging in July start to wake back up in August. And looks like it's early, but it looks like we're starting to see that Amazon and Apple will be that next test for the S&P and NASDAQ specifically to be able to get out of that July chop and back into the uptrend. So again, we're always going to skew to continuation. So if the trend was up, and it was very much so, let's not forget that the S&P and NAS hit how many all-time highs this year? So yes, my expectation is just like in April, after a tough month of a lot of chop, we're going to go back to continuation. Reversal is not the probability. Continuation is, especially when we look at the trend that was. All right, so with all that being said, that's where we start off this first day of August. And let's get into Our questions, as always. All right. J Moss is asking about the long bond, TLT. Sure. So look at the long bond. To look at TLT, what we want to do is look at the futures contract. So this is the more complete, nearly 24-hour version of the long bond. And then we have our 9:30 to 4 o'clock version of the long bond via the TLT ETF. So is it buyable? Now, the trigger is going to be not rate cuts, right, J-Moss? Because we've known this for a while. So we have to presume the September rate cuts are baked in. So now the question is, could we continue to punch up to higher highs? And then where would the zone of entry be, right? So the reason is there, right? We have the story. We have, if you will, the trade story, lower yields because of the rate cut. Now, how do we engage that? And that's going to be really simply, J-Moss, two really easy tools. One, are my candles green? These are the top tier candles. When they're green, that's bullish price action, that's bullish participation. And if those green candles sink down into the support, which is that gray zone you see automatically plotted on my chart, as long as we can sink that into that area, absolutely. Now, I would say we haven't been trending all that long. In fact, we could argue we haven't been trending this year at all, except for the downtrend that we saw in April. So this is still bullish chop, but it is bullish. And the candles help us out. So when I don't have the confirmation of a trend, which I don't, I do have the confirmation of bullishness, right? So we could have a bullish market, but not a bullish trend quite yet. The trend is the very last output, if you will, of higher highs and higher lows of momentum. That has to continue for long enough until it's no longer cake batter, but a cake, right? And we don't have a trend yet. It's not fully cooked. It's not there yet, but we definitely can be bullish. So as long as we can move down into that gray zone, that would be a great thing. Now, I would focus on the long bond futures. And then this is where the choose your own adventure comes in. You know, we have long bond futures options. We have TLT shares. Of course, we have the futures contract, right? And then we also have options on the TLT, and there you go. I would not watch this. And do you see how gappy it is, gang? Those are holes in the chart. It looks, like it's just jumping all over the place. And the reason it's jumping all over the place is when the cash close happens, when Wall Street is closed, bonds are still moving and grooving. And it's almost as if TLT just kind of jumps in for a certain number of hours every day. So this is why I say, don't look at TLT for the setup. Watch ZB. You'll find better setups because you've got a more complete look at the behavior of the long bond throughout what is a global marketplace, right? 23 hours, this is trading. All right, so thank you for the question on bonds. So let's jump on over to gold, because gold is in many ways related to bonds. And when I look at gold, which is a play on real yields. So real yields are essentially the lower end of the yield curve, maybe a 1 to 3 year note, versus the rate of inflation. And whatever that chasm is, gold responds to it, which is why you'll hear so often gold is a hedge against inflation. And the way we would measure that is through the real yield. I have to sneeze. Excuse me. Excuse me. Woo! All right. So apparently I'm allergic to gold. I can't be. I'm Indian. My mom would just disown me. So if I'm looking at the long bond to be long, keep an eye on gold too. And if you think, Rog, I can't trade gold full-size contract, micro gold, MGC, is a great alternative, but choose your own adventure. Just like the relationship between ZB and TLT, you've got a relationship between GC and GLD, right? So when GC sinks down into that range, you can look for calls on GLD for those of you that are watching the futures but still trading the ETFs. Yeah, thank you. I appreciate that. Yeah, thank you. All right, so next up is questions. All right, let's go take a look at a Russell and KRE, because KRE is still, when you look back on July, KRE was the number one by a large margin outperforming sector. So sector strength are the cylinders of the motor, which is the index. I still want to stay along the Russell. I still want to look for buying opportunities. I know it's stuck in a range. It has been the last 2 weeks. And KRE and Russell were a little heavy. not super surprising if you think about some profit taking at end of month. So where would profit taking happen? In the weak sectors like technology and semiconductors, those are the weakest of last month, or would they happen in the strongest sectors like staples, like regional banks? But we still want to stick with the long side, right? And here I am admittedly talking my own book a little bit, because the two sectors that we have the most positions in the sector secrets mastery are staples and the sector of KRE and the index of RTY. We continue to try to take advantage of the strength in those two sectors. Again, staples. So staples, think Procter & Gamble, Coke, Walmart, Costco, those names. Not all of them look great in staples. Costco has been a mess, but Coke has been fantastic. I'm looking for Walmart to remember that it was in an uptrend again. But overall, if we stick with what's been performing, it's that alignment of index sector stock that we're always looking for. All right, next up, Ren asks, could you take a look at UNG? Yeah, absolutely. So let's remember, UNG is natural gas, and natural gas is a futures contract. That's the NG futures. NG is absolutely in a downtrend, right? It's absolutely in a downtrend. It's below the equator, which are the white dots. It's in the bearish hemisphere. And the red candles tell me what? How long, by the way? This is what's so important about having multiple ways to understand the behavior of a symbol. So we've had the red candles since the 28th of June, right? So since the 28th of June, the candle's been saying, I'm not so sure we're going to find support as much as we're going to adhere to resistance. I'm not so sure that lower lows aren't the path. And you can see what's happened once those red candles really got some traction. So I would not be anything but possibly looking at long puts on UNG. So once again, keep an eye on NG futures, trade UNG. And another thing, if you want to sort of have this alongside the idea, Ren, of the natural gas, there are a group of natural gas stocks in the FCG. So I would also keep an eye on those. But as far as a straight up play on the natural gas futures, you've got two choices. I tend to keep an eye on UNG as the ETF alternative. But there is also another one that folks like to keep an eye on, and that's BOIL. And you see, they all look like natural gas. So regardless of which ETF, just make sure it's liquid. But regardless of which ETF you're going with, keep an eye on the futures contract, and that's going to map to the other choices of taking advantage of the fact that this commodity is in a downtrend. All right. Okay. Next up, actually, since we're looking at energy, let's go take a look at crude oil. Crude oil has had a wild couple of months. We started to see strength in June, started peaking in early July, and look at what crude's done. It was well above 80 for a bit, $80 a barrel, and now it's sunk back down below it. So crude is far from clear in terms of what it wants to do. But what I do know is I cannot be a buyer at the moment in crude because of the red candles. So you might say, Rog, so what do the candles tell you to do? Why do your charts look like Skittles? They do. They look like a bag of Skittles just exploded on my desk. And I love them. As long as you know what the colors mean, it's traffic light simple. Red is bearish. Red means there's a tendency of the candle, once it hits a resistance level, to stop and then head back down. It doesn't have to be to a lower low, but the tendency is for more weakness than strength. In neutral, it's, like neutral would be. It could be up, it could be down. We would take that within the context of what has been happening. Green is bullish. So if I'm taking a look at what's happening on the UNG with the red candles, you can see the red candles on CL and USO. So energy right now is weak. So I really don't want to try to pick a bottom. I don't want to start thinking this is where the floor is. There's two choices always, right? One choice is leave it alone until it starts behaving in the manner in which you want to trade it. So if you're thinking, Rog, I want to be long crude oil. Wait, Rog, I can day trade crude oil. Absolutely. Because the daily time frame, and this is so important, the daily time frame is going to map to a longer time horizon. We teach day trading and do day trading. We teach and do short-term swing trading. We also have long-term swing trading. And each one of those has an individual time horizon. In other words, how long do I expect the behavior to last? And that's a really important thing because it's not going to be forever, right? If I'm day trading, I'm today trading. What's going to happen over the next couple of hours to maybe the close? Boom, the window is shut. On the 1 hour chart, where we like to do some overnight swing trading, it might be 1 to 3 days. We've had some short-term swings that we get into and we end up scaling out of the same day. Am I going to not scale out because it was an overnight trade, or am I going to say my entry reached the target? It just did so on the shorter end of the time horizon, right? So my time horizon in a 1 hour would be far shorter than the time horizon, again, how long I could conceivably be in the trade, than the daily. The daily is very much something that could take me days to weeks, or at least to the expiration of the option or the contract. So, when we're taking a look at energy, remember that if I don't have clarity on natural gas, if I don't have clarity on crude oil, it's going to be very difficult to get clarity on the oil stocks. But we do know that coming up this week, we have the number 1 and number 2 weighted stocks in the energy ETF, and that's Exxon and Chevron. So we'll keep an eye on that and see if maybe we get some clarity post earnings, post this week, and whether or not these oil stocks can resume, even though crude's a bit of a choppy mess. Look how Chevron's kind of a choppy mess too, as is Exxon. They just happen to be a little bit more bullish. So if you're going to play energy stocks, be cautious, because we really want to see the alignment of the energy itself, the crude oil contract, to then the sector of XLE, and then lastly, the stocks. And that just kind of brings me to, one of the things that, we kind of, it's always under the surface, but it's really a constant, which is, how are you building your watch list? Is it based on macro? Is it based on trends? Is it based on alignment and relative outperformance? Or is it based on whatever they're talking about on TV today? So watch list building is probably the most difficult part of trading. Get that part right, and trading life becomes a whole lot easier, because I could put on the most perfect long call trigger position in a stock that doesn't have an alignment or a trend, and I'm just not going to get the results I want. So case in point, we talked about the strength in staples. Then we dug into staples and said, well, what's performing in staples? And there were 2 stocks that popped up, Coke and Walmart. Walmart didn't do what I wanted it to do. Cut it loose. Small losses, right? If you're thinking about the quote unquote secret to account growth, it is true. Cut your losses and let your winners run. But how do you do it? And a lot of it is that watch list building process. So Coke, we've got a monster winner in Coke already, even though it pulled back a little bit yesterday. No worries. We're built in from down near 65. So pulling back from 68, we've already paid ourselves. We're managing risk. And this is really the not so secret to account growth. Whether it's a small account or a Godzilla-sized account, it's still the same process. And as long as we can get the watch list right, we can get the follow through, and then we can worry about whether or not it keeps going into expiration. These are first world problems, right? First class problems. So get that watch list building process down. Use some of what we talked about here in Charts and Coffee, and I will see you tomorrow. Same time, same station. All right, gang, be good to each other. I'll talk with you soon.